ABC Thursdays.
Welcome back.
Grey's Anatomy is all new.
Why didn't you tell me you were pregnant?
The drama going down
Bungee jumping from the bridge, his cord snapped.
We need all hands on deck.
is unbelievable.
You think you're God's gift to this hospital? You're just another doctor.
My relationship with Catherine is complicated.
I'm gonna sue you.
Your lawyers know where to find me.
You're unbelievable.
Grey's Anatomy. All new Thursdays, 10/9 Central on ABC and stream on Hulu.
Welcome to the Learn Finance 101, where we break down essential financial insights to help you make informed decisions. Today we're diving into two very different approaches to investing, the top-down and bottom-up strategies. If you've been exploring the world of investing, you've probably heard these terms before. But what do they really mean, and how do they impact the way you build your portfolio? Well, stick around, because we are going to break it all down for you. So, let's start with the top-down approach. This strategy is all about starting with the big picture. Investors using this approach begin by analyzing macro-level factors, things like how the global economy is doing, what's happening with inflation, interest rates, government policies, or even geopolitical events. Essentially, they're trying to understand the overall environment in which companies operate. Once they have a sense of where the economy is heading, they might zoom in on sectors or industries that are likely to benefit from those big economic trends. For example, if the global economy is moving towards more sustainable energy, they might focus on renewable energy sectors like solar or wind power. Or if interest rates are expected to remain low, they might look at the sectors like real estate, technology, or others that could benefit from cheap borrowing. And finally, after identifying promising sectors, they go one step further to pick specific companies within those sectors that they believe will perform well. So in a nutshell, with the top-down approach, you start with the economy, narrow it down to sectors, and then drill down to individual companies. It's a big picture for a strategy. For example, let's say an investor notices that electric vehicles are gaining momentum due to environmental regulations or consumer demand. They start by focusing on the broader trend toward cleaner energy and then zero in on the electric vehicle sector. After that, they pick specific companies like Tesla or Rivian that they believe will benefit most from this trend. Now, on the flip side, we have the bottom-up approach. This strategy is almost the exact opposite. Instead of starting with the economy and working their way down, bottom-up investors begin by looking directly at individual companies, and they focus on the company's fundamentals. So they are analyzing things like financial statements, revenue growth, profit margins, management quality, and even the company's competitive advantages in the market. The idea here is that a strong company with good fundamentals can thrive regardless of what's happening in the broader economy. So even if the economy or its sector isn't performing well, a well-managed, innovative company could still deliver solid returns. These investors believe that strong companies can weather the storm no matter the economic conditions. For example, a bottom-up investor might come across a company with a fantastic product, solid earnings, and great leadership team. They are impressed by its potential for long-term growth, so they invest in it, even if the broader market or sector isn't doing particularly well at the moment. Now, what's the real difference between these two strategies? Well, with top-down investing, you are focusing on macro trends first. It's like saying, I think renewable energy is the future, so let me invest in the companies in that space. You are aligning your investments with where you think the economy is headed. It's strategic, but it can also be reactive to economic shifts. With bottom-up investing, it's more about the company itself. You're saying, I believe in this company's potential, regardless of what's happening in the world right now. So, even if the economy is shaky or a particular sector is struggling, A bottom-up investor is betting on the company's ability to succeed long-term. One big difference is in how these approaches handle risk. Top-down investors try to avoid sectors that might be in decline because of the economy, like steering clear of traditional fossil fuels in a world that is shifting to renewable energy. Bottom-up investors, though, focus more on the individual company's story and often take the stance that a strong business can succeed even in a tough environment. So, which approach is better? Honestly, it depends on your investing style and goals. Top-down investing is great if you like to keep an eye on the big picture and follow economic trends. Bottom-up is ideal if you are more interested in digging deep into specific companies and looking for hidden gems, regardless of the broader market environment. In fact, many investors use a combination of both approaches. You might start with a top-down view to get a sense of the economy and then use a bottom-up analysis to pick the best companies within the sectors you are interested in. Alright, that wraps up today's episode. I hope this gave you some clarity on the differences between top-down and bottom-up investing approaches. If you found this helpful, don't forget to subscribe and leave a review. We'd love to hear what investing topics you would like to discuss further. Thanks for tuning in, and until next time, thank you.